Hey everyone, welcome back to Corporate Decoder. Today Velo just filed an amendment to an 8K and I am seeing one key clarification that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is correcting how a big stock option award for their CEO is being described. And it gives us a clearer picture of their executive compensation strategy. So what we have here is an updated filing from Velo3D Incorporated. They originally put out a report back in February. This new filing is an amendment, meaning they are going back to correct or add information to that original report. Think of it like editing a document after you've already sent it off. The main reason for this amendment is to clarify details about a compensation package for their Chief Executive Officer, Arun Jeldi. The initial report had a slight misstatement about an expected stock option grant. This happens sometimes, especially with complex compensation plans. The company is essentially saying that how they described a performance-based stock option grant in the first report did not fully capture what the Compensation Committee, which is a group of board members overseeing pay, actually intended. This is not uncommon, as these agreements can be very detailed and sometimes wording can be a little off. The core of the correction falls under the section dealing with executive compensation. The original filing suggested that Mr. Jeldi would receive what sounded like an annual award, meaning something he would get every year. The company is now clarifying that this stock option award is actually meant to be a one-time award. This is a pretty significant distinction. Instead of getting a new award every year, this one-time grant is designed to cover a longer period, essentially replacing what would have been routine annual equity awards for about 4 years from 2026 through 2029. This suggests a more strategic approach to executive incentives, tying a large portion of the CEO's potential earnings to longer-term company performance, rather than annual increments. Now, let's talk about the actual award itself. This performance-based stock option grant, which they're calling the 2026 Performance Award, is expected to represent a substantial chunk of the company's stock. We're talking about 3% of all the company's outstanding shares on the day. The options are granted for context. An award of this size to a CEO can signal a strong alignment with shareholder interests as their personal financial success becomes closely tied to the company's overall market value. These options will have a long leash, a 10-year term. This means Mr. Jeldi has a decade to exercise them. The price at which he can buy these shares, the exercise price, will be set at the current market value of the stock on the day the award is officially given out. This structure, where the exercise price is set at the current market value, is typical for stock options and is designed so the CEO profits if the stock price goes up from the grant date, not just because of the passage of time. The really interesting part here is how these options will become his to use, or vest. It is tied directly to market capitalization, which is the total value of the company based on its stock price. This is a performance metric that directly reflects how investors perceive the company's value and future prospects. The options will vest, meaning they become exercisable, only if Velo3D hits certain very ambitious market capitalization targets within 5 years. The first milestone is hitting a market cap of $1 billion. At that point, 10% of the options will vest. This is a significant target and shows the company's and the compensation committee's aspiration for growth. If the company manages to grow its market cap to $3 billion, another 20% of the options will vest. That brings the total to 30%. Then, if they climb further to a $5 billion market cap, another 30% will vest, making it 60% of the total award. And for the grand finale, if Velo3D achieves a massive $10 billion market capitalization, the remaining 40% of the options will vest. This reward structure is clearly designed to incentivize extreme long-term growth and value creation for shareholders. It is a big bet on the company's future potential, requiring them to significantly increase their valuation multiples from where they are today. A crucial condition for all of this vesting is that Mr. Jeldi must remain employed by Velo3D throughout the entire period these milestones are achieved. This is a common way to ensure executive loyalty and continued leadership as the company strives for these ambitious goals. If he leaves, he forfeits any unvested options. The plan is to grant these options soon after the company's annual meeting of stockholders this year. However, there is a potential hiccup. If the company does not have enough shares available in its current employee stock plan, known as the EIP, to cover this large award, they will have to adjust their approach. This could mean granting some options now and the rest later, or even offering a different form of compensation. This highlights a potential constraint on their ability to execute this specific compensation plan as currently envisioned. So, to wrap up this amendment, the company is just making sure the description of this big CEO stock option grant is accurate. It is a one-time award tied to very aggressive market cap growth targets over 5 years, which is a pretty strong performance incentive. Everything else in the original filing remains the same, and the report is signed by James Suva, the Chief Financial Officer. This filing clarifies the magnitude and structure of their CEO's incentive plan, pushing for significant long-term growth based on market cap milestones. Now, looking at this big picture, Velo3D Inc. is in a position where they are trying to motivate their top executive with a very large performance-driven award. The fact that it is a one-time award instead of annual grants suggests a strategy to heavily incentivize a significant leap in company valuation. The ambitious market cap targets, culminating in $10 billion, indicate a strong belief in the company's future potential to grow substantially. This is a high-stakes incentive plan where the CEO's personal wealth is directly linked to achieving transformative growth for the company. It is a strategy that can be very effective if the company delivers, but it also sets very high expectations. The risk I am watching is whether the company can actually achieve those astronomical market cap targets, which would represent a massive increase from its current valuation. What I am actually looking for is how the market reacts to these clarified executive compensation structures, and if it aligns with their stated growth ambitions. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, give it a like and subscribe for more, and join our Discord community linked below.